Good morning, all of you. Today, we are going to discuss Unit 4, Block 2. The topic is composition of national income. In this class, these are the things that we are going to discuss. What is the objective of composition of national income and introduction about national income accounting, definition of national income, concept of national income, what are all the elements of national income, and methods of national income. There are three methods: production method, income method, and expenditure method. And what are all the problems that we are facing while measuring the national income? These are the topic today we are going to discuss. In this unit, what is the purpose of studying this unit is to understand the fundamentals of national income accounting and to make the student familiar with elements of national income. National income is a sum of total of value of all the goods and services manufactured by the residents of the country, that too in a particular year, within its domestic boundaries or outside. It is the net amount of income of the citizen by production in a year. To be more precise, the national income is the accumulated money value of all final goods and services produced in a country during one particular financial year. Computation of national income is very vital as it indicates the overall health of our economy for that particular year. The aggregate economic performance of a nation is calculated with the help of national income data. The basic purpose of national income is to throw light on aggregate output and income and to provide a basis for the government to formulate its policy programs to maximize the welfare of the people. The Central Statistical Organization, CSO, calculates the national income in India. So keep it in mind, national income is nothing but in a particular year, what is the total output produced in that particular country, including the domestic boundaries as well as the outside the country. There are many definitions, but those definitions are categorized under two categories. One definition in a traditional view, the other definition is a modern definition. So the definition of national income is of two types. One is traditional definition of national income. The second one is modern definition. Let's see the traditional definition. According to Alfred Marshall, he defines the national income in this way: the labor and capital of a country acting on its natural resources produce annually a certain net aggregates of commodities, materials, and immaterials, including services of all kinds. This is the true net annual income or revenue of the country or national dividend. Professor Alfred Marshall have rightly pointed out this particular national income is for a particular year and total output of what are the commodities we have produced in a material way, in a service product also included. So the total value of production in a particular year by all three sectors is called national income. But the scope of this particular definition is very limited because it includes only the production of material. But how to calculate the service and other things? So we have to approach scientifically. So a modern definition was given. In this definition, we are having a major two indicators called gross domestic product and gross national product. Let us start with the gross domestic product. Gross domestic product, abbreviated as GDP, is the aggregate value of goods and services produced in a country. GDP is calculated over regular time of intervals such as a quarter or a year. GDP as an economic indicator is used worldwide to measure the growth of the country's economy. Goods are valued at their market price. So, for example, all the goods measured in a same unit, for a dollar is used. Things without exact market value are excluded. The national income is an aggregation of the remuneration received from four factors of production, namely land, labor, capital, and the organization. The remunerations of these four factors of production are rent from the land, wage from the labor, interest earned from the capital, and the profit generated out of administration or the organization. For the four factors of production, these are the remuneration of four factors of production: land, labor, capital, and organization respectively. The rent, wage, interest, and profit. This is a formula for calculating the national income. The total rent plus total wages plus total interest and total profit. If you sum up these four remuneration out of factors of production, we can get the value of national income. There is another way to express the composition of national income is aggregation of total outlay, that is output, in the three major sectors: agriculture sector, industrial sector, and service sector. What is the output in agriculture sector, plus what is the output in the industrial sector, and what is the output of service sector? It is called sectorial composition of national income. The sectorial composition of an economy is the proportionate contribution of different sectors to the gross domestic product of an economy during that particular year. It gives the share of agriculture sector, industrial sector, and service sector towards GDP. Now, let us discuss the concept involved in the national income. The national income is the total amount of goods and services produced within the nation during the given period of time, say 1 year. The national income is total amount of goods and services produced within the nation during the given period, say 1 year. It is a total of factor income like wage, interest, rent, and profit received by the factors of production from labor, capital, land, and entrepreneurship of the respective nation. There are many elements. The following 7 are considered as elements of national income. What are they? GDP, GNP, NNP, NI, PI, DI, and PCI. GDP is gross domestic product. GNP is gross national product. NNP is net national product. Then NI is national income at factor cost. PI is personal income. DI is disposable personal income. And the last one is PCI, per capita income. These 7 elements explain the facts of economic activities. These 7 are called elements of national income. Let us discuss these elements of national income one by one. The national income is a total amount of goods and services produced within the year. Already we said. the national income that particular goods and services produced within the year, that must be from the factor price. First, let us start with the GDP at market price. The gross domestic product at market price is a money value of all goods and services produced within the domestic domain with the available resources during the year. In easy way, we may say gross domestic product is equal to price of the goods and services multiplied with quantity of goods and services. That is why the formula is GDP equal to P into Q, where GDP is a gross domestic product, P is the price of the services, and Q is the quantity of goods and services. This particular GDP is having 4 different components. The 4 components are the consumption, investment, government expenditure, and net foreign export of the country. That is the difference between the export and the import, the net export, we may say. So the formula runs like this: GDP equal to C plus I plus G plus X minus M, where C is a consumption, I is a investment, G is a government expenditure, X minus M is a net export. Now, using this particular value, now we have to calculate the next element, gross national product. The gross national product is a money value of final goods and services produced in a year by the resident of the country within the domestic territory as well as from abroad. The gross domestic product is a value of goods and services that the country's citizens produce regardless of their location. The formula runs like this: GNP equal to GDP plus NFIA. NFIA is a net factor income from abroad. So if we expand the formula of GDP, then it is easy to calculate the GNP. GNP equal to consumption plus investment plus government expenditure plus net export plus net factor income from abroad. If we add these 5, we can get the net national income. Gross national income. With this value, now we have to calculate the net national product at market price. The net national product at market price is a money value of net output of final goods and services produced by an economy during the year and the net factor income from abroad. NNP is GNP minus depreciation. As we know, GNP is a aggregation of consumption, investment, government expenditure, net export, and net factor income from abroad. From this value, if we deduct the depreciation, then we can get the value of net national product. The formula runs like this: NNP equal to GNP minus depreciation. What is GNP? C plus I plus G plus X minus M plus NFIA. There is one particular thing, not only the depreciation, we have to subtract the indirect taxes also. Then the value arrived is the net national product. First, we have calculated the gross domestic product by adding 4 factors: consumption, investment, government expenditure, and net export. Then we calculate the net national product. In that particular thing, we are subtracting the indirect tax value and the depreciation. Now, let us move to the next element, the national income. The national income is also known as national income at factor cost, which means the total income earned by resources for their contribution from different factors of production. Hence, the sum of this income received by factors of production form the remuneration. As I said earlier, the rent, wage, interest, and the profit are called national income. So the national income can be formulated by using a particular equation. First, we have to calculate the net national product. If we add the subsidies and subtract the interest taxes, then we can get the national income at factor cost. In other words, this is the actual value of the national income. National income equal to consumption plus investment plus government spending plus net export, then net income, and we have to subtract both the depreciation and indirect taxes, and we have to add the subsidies given to the public. When we make these 7 elements, the value arrived is called national income at factor cost. So first, we studied the gross domestic product, then second one, the gross national product, and third, net national product, then national income at factor cost. The fifth element is the personal income. The personal income is the total money income received by individuals and households of the country from all possible sources before direct taxes. Because when you deduct the direct taxes, then it will become disposable personal income. Therefore, the personal income can be calculated by using the formula PI equal to NI minus corporate income taxes minus undistributed corporate profit minus social security contribution, and we have to add the transfer payments. So how to calculate the personal income is, first we have to calculate the national income at factor cost, and we have to subtract 3 values. One is the corporate income taxes, then the second one is undistributed corporate profit, and the third one is the social security contribution. After subtracting these 3, some transfer payments will be there. It is a gain only. So we have to add that particular thing. Then the final value arrived is the personal income. From the personal income, it is easy to calculate the disposable personal income, because it is an income left with the individual after payment of the direct taxes from the personal income. It is the actual income left for disposal, or that can be spent on the consumption by the individual. The formula is very easy. Disposable personal income is personal income minus direct taxes. So the link between the personal income and disposable personal income is the amount of tax paid for the income earned. That too, it is a direct taxes. The last element is per capita income. You can expect on section A goes define per capita income, because this is the main indicator to measure the economic development or economic growth of the country. We used to say PCI. PCI means per capita income. The per capita income is calculated by dividing the national income of the country by total population of the country. PCI is total income of the nation divided by population. So totally there are 7 elements. I will summarize this particular question. You can expect section C explain the elements of national income. First, you should write what is national income is. You have to write the definition, and you go for the elements of national income. There are 7 elements: gross domestic product GDP, gross national product GNP, net national product NNP, national income at factor cost NI, then personal income, disposable personal income, and finally the per capita income. For calculating these 7 elements, we need some methods. So the methods of national income accounting is, 1 minute. There are 3 methods. One is called product method, second one is called income method, and the third one is called expenditure method. Let us see one by one. First, we start with the product method. In this method, there are 2 approaches. One is called final product approach. The other one is value added approach. First, let us see the final product approach. it is expressed in terms of gross domestic product. According to final product approach, the sum total of market value of all final goods and services produced by all productive units in the domestic economy in an accounting year is estimated by multiplying the gross domestic product with the market prices. Being gross, it includes depreciation. Being at the market price, it includes net indirect taxes. And being a domestic, it includes the production by all production units within the domestic territory of the country. It includes the value of only the final goods and services, no raw material or intermediary goods. So this final product approach is nothing but it is calculated with the GDP, and it excludes many things, particularly as it includes the depreciation value, market price value, and the value of indirect taxes. All these things is already with there. So the value calculated in final product method will be a bit higher side. So this is not the actual thing. For initial stages, we can adopt final product method. For policy frame, it is not possible to use that particular value. So we have to go for the better approach. It is called value added approach. This method measures the contribution of each producing enterprises to production in the domestic territory of a country in an accounting year. According to this method, the net value added at factor cost by all the producing units during the accounting year within the domestic territory is aggregated, that is sum up. This gives as a value of net domestic product at factor cost or the domestic income. So these are the steps involved to calculate the value added approach of national income. Identifying all the producing units in the domestic economy and classifying them into industrial sectors such as primary, secondary, and third different sectors. What is the total value? Then let's move. We have to move to estimating the net value added at factor cost by each producing unit, deducting the intermediary consumption, depreciation, and net indirect taxes from the value of output. After estimating this, next we have to estimate the net value added of each industrial sector by summing up net value added at factor cost of all producing unit falling in each sectors. Computing the domestic income by adding NVA at, that is net value added at factor cost, or also should be considered. After completing all these things, we have to estimate the net factor income from abroad, which is added to the domestic income, which is derived from the national income. The imputed rent of the owner occupied houses is also included in calculation of the national income. So in this way, we have to calculate the national income through value added method. The imputed value of goods and services produced for self-consumption are also included. The value of own account production of fixed asset by enterprises, the government, and the household. This must be considered. Then only the value will be correct. Thus, according to value added method, the gross national product is, we have to calculate the value of output in a primary sector, that is aggregate sector, minus intermediate consumption, what they are consuming on your own. Then the value of output in the secondary sector, that is industrial sector, and the intermediate, we have to deduct the intermediate consumption. Similarly, the value of output in the tertiary sector, that is service sector, the intermediate consumption should be reduced from that value. And finally, aggregating these three, and we have to add the net factor income from abroad. Then the value arrived is called national income. This will be the right value for framing the economic policies. So with this, we are moving to the next method called income method. The income method measures the national income from the side of the payment made to the primary factors of production for their productive services in an accounting year. Thus, according to the income method, the national income is calculated by summing up the factors income of all the normal residents of the country earned within and outside the country during the period of 1 year. We have to choose a particular year and we have to calculate that. The income generated is nothing but the net value added at factor cost by factors of production, which is distributed in the form of money income amongst them. Thus, if the factor income of all producing units generated within the domestic economy are added up, the resulting total will be the domestic income, or it is a net domestic product at factor cost. We used to call NDPFC, net domestic product at factor cost. By adding the net factor income from abroad to domestic income, we can get net national product at factor cost. We can get the gross national product is the addition of all factor income generated in the production of goods and services. While measuring the GDP, we must include only those income flows that originated with the production of goods and services within that particular period of time. We should be specific with the time perspective. The components of factor income are, there are 4 different elements. One is how much value the employees are getting, that is employees compensation. Then profit, rent, interest, and mixed income. Some people may receive rent from the next, they may own more than one house and they may receive, and they may deposit in a bank, they may receive the interest. So there are 6 different value: employee compensation, profit, rent, interest, royalty, mixed income, and that particular, it may be dividend. So these are all the things jointly we can get the net national product. Thus, the national income is compensation of employees for operating surplus. Here also we are following some algorithm of calculating the national income, especially under income method. These 5 steps should be followed. First, we should identify the enterprises which employ factors of production. What are the, how much labor employed, how much money is invested, and what is the administrative cost. Then we have to classify various types of factors payment like rent, interest, profit, and mixed income. After that, we should estimate the amount of factor payment made by each enterprises. And finally, we have to sum up all these factor payment in a domestic territory to get the domestic income. Once domestic income is calculated, then estimating the net factor income from abroad also should be added to the domestic income to derive the actual value of the national income, because we have to add both domestic and abroad. What are the payment that we have made? The sale and purchase of second-hand goods are excluded. The imputed rent of owner-occupied houses and production for self-consumption are included. So this particular point we should keep in mind. What we have to do, the secondary sales will not be, second sale will not be included, it is excluded. But self-consumption or self-occupied house, these things will be included. The income from illegal activities are not included. Suppose these things we cannot identify, but sometimes the value of that national income may differ because of this particular issue. The direct taxes like income tax and other wealth tax like that are paid to the employees from their salaries, or these payments should be included while calculating the national income through income method. This is the last method that we are going to discuss, is expenditure method. The GDP can be measured by taking into account all final expenditure in the economy. There are 3 distinct type of expenditure as they are committed by household, industrial firms, and government. So based on their expenditure from household expenditure by industrial firm and expenditure made by the government. If we aggregate these three, we can get the value of national income. The expenditure are classified into following types. What are they? First one, private consumption expenditure. The second one is the government purchases certain goods and services. It is called government expenditure. We call it as E. And there are some investment expenditure. That is the third element. The last one is the net export. That is the difference between the export made and the import made. That is X minus M. Therefore, the gross domestic product and the expenditure method is C plus I plus G plus net export. The following steps are involved while calculating the national income through expenditure method. First, we should make identification of economic units incurring final expenditure. The second one is classification of final expenditure. It may include many things. One is the private final consumption expenditure, government final consumption expenditure, and gross final capital formation, and changes in stocks. That is secondary market. And finally, the net export. With this, the third step moves like this: measurement of final expenditure from the above component. First, we should identify the economic units. The second one is we have to get the all final expenditure made by different sectors, and we should measure the final expenditure of these components. And after completing this, estimation of net factor income from abroad also added. That is NDFAC. Avoid double counting of goods. Expenditure on purchase of second-hand goods are excluded, and expenditure on purchase of old share are also excluded because it's a secondary market operation. And one more thing should be excluded is government expenditure on all transfer payments. So if they gave some additional value in order to increase certain things, those transfer payments should not be included. Then the value will be not be the right value. So there are three methods. One is product method, income method, and expenditure method. While implementing these methods, the national income accounting facing certain shortcomings. We call it as problems in measuring the national income. The problems in the measurement of national income are: the national income measures domestic economic performance and not the social welfare, because our purpose is to calculate the performance, but our attitude with the social welfare. For real economic growth, there should be a strong positive correlation between these two. The national income understates the social welfare. Non-market transaction like homemaker service and do-it-yourself project are not counted, because the service of the mother is enormous, because she is cooking, she is washing the clothes, she is cleaning the vessels. All these things, that is a service product, that it has some value, but that particular thing is not included in the national income. So this is a problem of calculating the national income. The national income does not measure an increase in the leisure or work satisfaction or changes in the product quality. So this is also not included in the national income. This is a problem. Definitely the value arrived by excluding these important elements. Definitely it's a problem of calculating national income. The national income does not accurately reflect the changes in environment, like oil spill cleanup is which is measured as positive output, but increase in pollution is not measured. It is a negative. So there are some positive values and negative values which are not considered while calculating the national income. The per capita income is a more meaningful measure of living standard than the total national income, but it is very difficult to calculate the per capita income exactly, because the population is keep on changing. There is a death rate and birth rate, and we have to maintain a proper data, but approximate value only used. There is a problem of double counting. One more problem is called double counting. This problem of double counting could be avoided by utilizing the value added approach. If we adopt the final product approach, this double counting is possible. But when you use the value added method, this double counting method may be avoided. The problem of depreciation is another issue while estimating the national income, as there are different methods in calculating the estimating that particular depreciation value. Straight line method, multiple methods. So there are many methods to calculate the depreciation. Out of their convenience, they will say some value. So that particular value of depreciation will affect the total figure of the national income. The inclusion or the exclusion of certain items in the national income accounting cause confusion. Some people may say this must be included, but other people say don't include. So there are different states and there are different group of people, and they are having different fields. So based on their convenience, they will express some value which result in problem in calculating the national income. One more problem is the rent of the owner occupied houses, because it has been shown but he is not paying anything, but some value is added as HRA, house rent allowance. So this particular value will disturb the total national income value. The sale or purchase of second-hand goods are included because of the second-hand thing. There is a transaction is taking place. There is a exchange of money is there, but still we are not including that. The another major problem is the illegal activity. The value of illegal activity is sometimes included in that, but it is our oversight. It has happened. We are not supposed to add that, but it will come. The income from illegal activities are not included, but actually it is there. The direct taxes such as income tax is paid by the employees from salaries, TDS is included, but most of the people will evade, they are not filing properly. So the value of arrived while calculating the national income is not correct. Then there are many challenges and difficulties in getting information, especially related with the underground economy, because they may earn some particular income, but they will say only this much. So there will be a hoarding, there will be a black money. So because of all these things, we find very difficult to measure the national income. With this, we will complete the class, and in the next 2 minutes, let me sum up what are all the things that we have studied in this particular unit. First, we defined what is national income is and what are the economic indicators affect the national income. Then there are 7 elements of national income we studied, and there are 3 methods of calculating the national income: product method, income method, and expenditure method. And finally, we have listed out the problems in the national income accounting. In this particular unit, the keywords are that those 7 national income. Apart from that, the net factor, other indicators which influence the national income. But the keywords are GDP, GNP, NI, PI, DPI, and PCI. These are the keywords, and all these elements, they may ask define that particular element of national income. So in this particular unit, you can expect 2 section A questions. That is a possible. 1 section B question is confirmed. So in section C, they may ask explain the elements of national income, or what are all the problem faced in the national income. So these are some of the expected questions in the semester end examination. Thank you all of you for watching this online video from ODL of Wales University. Thank you. We will meet in the next class.